Hello, everybody, and welcome to the Trading with Ashley show. One of my videos with my daughter Landry teaching her how to sell covered calls on her position was so popular that I thought I would dig a little bit deeper into the whole concept of covered calls so that I can help you make the best selection. And I have a wonderful trade hack. I was sharing this with my community today. I go live with them twice a week and we go over lessons and answer questions. And this was one that they found extremely helpful if they have to roll a covered call, how to get out of the position without taking a loss. So I wanted to share that with you. So here's the things that we're going to go over today. But first of all, I want to explain what a covered call is. If you have 100 shares of a stock, you can generate extra income from selling covered calls against those shares. Now, as long as you go above the price that you acquired the shares at, you cannot lose in this situation. So that's a wonderful way. If you want to get into the world of selling options, this is the way to do it. In fact, this is how I broke in to the world of selling options. It was selling covered calls on stock that I owned. And I love it so much because it's a little bit safer in the fact you really can't hurt yourself financially. You can leave money on the table, but I have a hack for that I'm going to go over with you. And so what we're going to review today is when is the best time to sell a covered call. I am going to take you into some technical analysis and show you in layman's terms exactly what to look for. But then we're going to take it a step further. We're going to go deep into the option chain, and I'm going to show you what to look for on the option chain. And then I'm going to take you into my trade hack. So let's get started. If we're going to use NVIDIA as a good example, I am taking you to the charts in Yahoo Finance so that you can get a better sense of price action and where it may end up. Right now, we are looking at the 1-month chart. And the reason I look at the 1-month chart is if I intend to sell either weekly covered calls or maybe something in a couple of weeks, if I'm going to look at a longer time frame, let's say I want to do monthly, then I would want to look at the 3-month chart instead. Because the more time that's part of the equation, the more accurate the data. But if I'm going to end up selling a covered call that will expire in a few weeks, I'm comfortable with the 1-month chart. Now, let me share with you what you're seeing on this chart. The first thing that I want to look at is NVIDIA having a green day? Well, that box is checked. It looks like we have had about a 1.6% increase today. So that's good. Green days are important because you're going to get more premium on a green day if you are selling a covered call. The next thing I want to go and look at is the RSI. It's right down here. It's this black number 51, and it stands for Relative Strength Index. Now, the reason that this number is important is it's going to advise us on whether or not a stock is in a bullish or a bearish state. If we are 50 or above, that means we're in a bullish state. If we are below 50, then we're in a bearish state. And the reason that's important is we are going to look at levels of support based on this number. So because we are 50 and above, we are going to look at right here, the middle line right here. You see where it says 115 in purple? That is the 50-day moving average, and that's an important line of support. Also, the 20-day moving average is right in the middle of the Bollinger Band. It's about at the same price, really, just maybe $1 higher. So these are critical levels of support when a stock is in a bullish state. And this will show you, okay, this is good to know if I'm selling puts, but now I'm going to be selling calls. And so if you are in a bullish state for a stock and you want to sell covered calls, you want to look at the top of the Bollinger Band. Right here, we are looking at 127 is the top of the band. So I'd want to consider anything around 127.50 or higher. Now, if you're wheeling the stock and the intent is to have it taken away, then you might want to come just right below the band, maybe come in at about 126.50 if you have appreciation built up in the stock and you are using the wheel strategy to generate income. But if you want to hold on to your shares and just generate income, then you want to shoot slightly above. And the reason you want to shoot above the band if you intend to hold on to your shares is, let me show you what happens when a stock goes above its band. You see right here, this was on, it looks like August 19th. It went above the band just for a little while, and then it retreated back under the cover of the band. And then you see down here on the falling down side, it fell right outside of the band for a little while, but then it quickly recovered and went inside the band. So these bands are respected, but what could change it is a catalyst, either positive or negative. It would cause these bands to expand and it would be more volatile. When bands expand and they have a larger bubble that they're dealing with, then that's when the volatility is high. And when they're in a tighter range like this and compressed, then the volatility is not as high, and it's actually easier to trade when you have a more linear look on your bands because the lines are pretty easy to tell without that much volatility. Just some general things to consider. The other thing that you always want to consider is the volume. And these bars down here indicate volume. And it's always helpful to see, is it the green volume that's pushing it up, or is it the red volume pushing it down, and how tall are those bars? So you can see if you came over here, August the 5th, when everything dropped, I mean, that was kind of the Armageddon day for a lot of our stocks, then the volume was super high and tall, and it was, of course, red, but it recovered quickly. So ideally, if you were one to look at covered calls, we're going to shoot for right up here. Now, I want to go look at the actual option chain because that gives us a little bit more information so we can be laser focused on exactly what level to sell our covered call at. It's really helpful when you get to an option chain to start to look at all the different components that help make up your trade. And so at this point, if I want to go a couple of weeks out, I am going to select an expiration date. Right here, I'm going to select 10/18/2024. Now, this is a great expiration date also if you're going to sell monthly options, because the third Friday of every month is when the institutions do all of their options, and you can get a better indication of where all the price action is. So once you select that date, then it's going to populate all the various options for this particular date. Now, calls are going to be right over here to the left and puts are to the right. So we're focused on calls. And if you remember, we had wanted to look something around that 127 level. So right here is where we are currently at in price action. And if we go to the 127 level, you can see right here all the information that's going to help us make our decision. So the first thing you want to look at is delta. Now, when you are looking at delta, this is 0.26. So basically what this is telling you, it's actually telling you two things. One, there's about a 26% chance that on our expiration date that the price action will end up right here at 127. So that's helpful to know so that you can decide whether or not you intend to give up your shares or you're hopeful that they don't get taken. The other thing it's telling us is that this option right here that today sits at $1.70 a share, so this would be $170 if we sell this call option, then if NVIDIA starts to go down $1 for every dollar it goes down, this right here that we got 170 for, it will decrease by 26 cents a share or $26. Also, the opposite is true. For every dollar from the point that we sell that NVIDIA goes up in price, then this is going to go up in price by $26. So if you sell the option today and you get $1.70 for it, so $170, and tomorrow you see that NVIDIA has moved up $1, you are going to see this at a higher amount. It'll be $1.96. And if you see in your broker, it's going to show you that you're actually losing the trade. It'll show you negative $26. But in reality, you're not really losing that money. It's just showing you missed opportunity. So that's a very important point that I like to share with all of my students, because some of them, unfortunately, will get out of the trade thinking that they're losing. And if they would have just waited, then the price would have retreated and it would have been just fine. So that's something for you to consider when you're watching and managing the trade. But if I sell this 127 put, and this is a good delta to consider, 0.26, I will get $170. Now, I do like to tell people if they want to be ultra conservative to ensure their shares are not called away, then they more than likely want to go to a price that has something lower than 0.2. So if I look right here at my option chain, right here, 130 has a 0.18 delta. So that might be a good spot, or going right below it to a 0.16 delta. But as you can tell, your premium's going down for every dollar that you go down. But I wanted to show you something super interesting right here. You see here, this has got 95,000 in open interest. Clearly, this is the highest level of open interest for any strike price around it. So there's a lot of people locked in on this $130 strike price, and that is helpful to know, and it might help you make a better decision. Maybe you want to go ahead and sell this one along with everybody else in these institutions. Or if you want to be a little bit safer, line yourself up at 131 and sell this one instead. Because once all these orders right here, 95,000 in open interest and 41,000 in volume, once these orders start getting filled, that will more than likely push the price of NVIDIA further down. And that will protect your trade even more, this 131. So that's just something for you to consider and might help you make a smarter decision when you are selling the option. So let's assume for the sake of this example that we are going to stick with this $130 mark. So I do sell right here because I'm indicating that I am selling the option. When it gets to your ticket, here's what it looks like. This is an option. This is NVIDIA. Here's my expiration date. This is my strike price, 130. I've agreed to have my shares called away at 130. I'm dealing with a call. This is sell to open. You'll have 4 different options, and this is an opening trade, so it's sell to open because you are selling the option. The quantity is 1 if you are wanting to sell an option on 100 of your shares. And then right here, I always like to look at a limit order, and then that way you can control the trade a little bit more. Looking here, it looks like it's offering 104, so you can do that. Or if you want to put in a higher amount, you can and just wait to see if the trade gets filled. So if NVIDIA keeps rising up on the day I'm making the trade, I might go ahead and put this in a little bit higher and just see that if maybe it'll grab it later in the day. And then you would preview and submit. And then what will happen is if we get to our expiration date and NVIDIA is $130 or higher, it will take your shares. And so a lot of times that makes people nervous. And that's where the roll comes in. You would want to roll the trade at that point. Now, what rolling the trade would involve is it would involve buying back this option that at the time it's going to be more expensive than what you sold. And there's going to be a debit that you pay. Well, herein comes the trade hack that will help you not have to see your account go down if you decide to buy this option back and then sell an option once you allow the stock to keep running a little bit further. For my trade hack, I want to go back to the option chain. Let's go look at the $131 strike. Remember we had discussed delta and how it causes the price of the option to change for every dollar movement. So this $131 strike price has a 16-cent delta. Well, you can calculate how much it would cost to buy this option back if NVIDIA got close to your strike price. So right now, if NVIDIA is at 120 and we get to 130, that's a $10 movement. So looking at this particular option, you would want to take the 16 cents and you'd multiply it by 10 because you would have this option, this 89-cent option, changing by 16 cents for every dollar movement. Well, if you multiply this by 10, that equals $160. So it's safe to assume if you made the decision to get out of this trade, you can understand that you are going to have to spend $160 to get out of this trade. So knowing that, you would want to, at the time that you sell the original call, you would want to go ahead and buy shares that would help fund the amount it would cost to get out of the trade if it breached your strike price. So in this example, if we go from the price point of $120 a share to $130 a share, that's a $10 price movement. So to fund that, you would need 16 shares of NVIDIA that you would purchase at the time that you sell the call. That would cost you $1,920 at $120 a share. However, once it gets to $130 a share, now you'll be sitting on $2,080. If you go ahead and sell those shares, to fund repurchasing the call, that would be the $160 that it would take to buy back that call. Once you purchase the call back, now your shares are free to run. You can wait until it runs a little bit further before you start trying to sell calls again. I hope you found that helpful and it stretches your mind a little about how options and then little trade hacks can work in your favor. After all, when I first got started in this business, I was actually confused. I was like, when to sell a call, how to sell a call. But once you learn the basics, then you start stretching your thinking and you actually come up with more ways to make money. So in that spirit, I am actually hosting a very special boot camp. Now, I run boot camps. I run them a lot, and it's got both men and women in it. But I wanted to carve out a special boot camp just for women. If you've always wanted to learn how to trade options, but you've been intimidated by the process and you just wanted to be a smaller group type setting, then you may want to consider joining my women's only boot camp. If you're interested, click the link below. We'll have a brief conversation and we'll explain everything, what it's all about. We'll go over the cost. But others that have joined my boot camp, they have rated it the highest rating on Trustpilot that I've seen for any financial program. So I'm really excited about that. It's quite the accomplishment, and I would love for you to be a part of this. Now, don't worry, guys. I also have the mixed boot camps for both men and women, but I did want to do something special just for women so that I could provide a comfortable environment for you to learn. This stuff is not hard to learn. You just need to take that very first step. Remember, if you're with Trading with Ashley, there is no trader left behind. If you want to see the original video where I am teaching my daughter how to sell covered calls on Palantir, click right here.